You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And before we begin, I want to remind you of a couple of things. One thing is that there is a website associated with this podcast called wealthformula.com. Go check it out. And it is where you're going to go sign up for things such as our Accredited Investor Club if you are interested in participating in some of the opportunities that flow through there that are only available to those who are accredited investors and those who have signed up for the group and gone through our onboarding. Again, and what is an accredited investor? An accredited investor is somebody who either is one or isn't, basically, but it is somebody who makes $200,000 per year or $300,000 per year if filing jointly, has about 2 years record of that with a reasonable expectation of continuing to do so, or a net worth of $1 million outside of a personal residence. If you are one of those, you are an accredited investor. Put up a plaque or something. You didn't even need to, go to school for it or take a test. You just are one, and you can sign up for our Accredited Investor Club, aka Wealth Formula Investor Club at wealthformula.com. And there's a flurry of activity going on through there you may want to check out, particularly in the real estate spaces. We continue to be in a sort of a sideways market where, the buying opportunities are still there. We haven't seen big turnaround in terms of values and stuff like that. And so it's a good time to buy. It's not a great time to sell. How long will this last? Who knows? I think a lot of it is predicated on the direction of the Fed's. The Fed is going with rates. Obviously, they've slowed down cutting, so that's making the market sort of continue to be a buyer's market right now for those who can participate. And we certainly have hitched our wagon to some winners in terms of the operating side for this journey from the bottom of the cycle, hopefully to the top. So again, if you are interested, check it out. Go wealthformula.com and sign up for Investor Club. Get onboarded there. Now, we're going to talk about taxes today. Taxes are a big, big part of what we talk about on this show. I think that for most people, I would say that taxes are nothing more than a necessary evil, right? One of those death and taxes type thing, a burden to be minimized, avoided at all costs. Of course, that's true too. You want to avoid them as much as you can. But the mindset itself might not be the most productive one to take. So if you consider that the tax code might not just be a drain on your resources, but maybe even a potential roadmap to creating some wealth, that might actually work to your advantage. The truth is, as it turns out, the tax code is nothing more than a series of incentives. It's filled with opportunities for those who understand how to use it. So as painful as it may be, think of the government sort of like a business partner, right? Offering rewards for certain behaviors, whether that's investing in houses, creating jobs, or producing energy. If you do that, you're rewarded, and you see that over and over again. And these aren't quote unquote loopholes or tricks. They're just deliberate strategies to stimulate economic growth. And that is the way to view the tax code, in my opinion. If you do that, the government's going to lead you to some potential opportunities. Frankly, that's why a major reason why I am in real estate, right? It's tax efficient, but most people miss the opportunity. Why? Because they treat taxes as a sort of a once a year obligation rather than a year round strategy. And that is not a good way to do it, because it's really hard. If you come in November, December, I've had people do that to me and say, hey, Buck, I made a bunch of money this year. What should I do? First of all, I'm not a tax professional. I do have some ideas because I'm knee deep in this stuff all the time, but those ideas typically need to start in the first quarter of the year, not in the last quarter. Anyway, the idea is basically that most people react instead of plan, and that's really not a good way to do this. And in doing so, they leave money on the table, money that you could use to, fuel your financial future. Listen, every financial decision has implications, whether it's, how you structure your business, where you invest, how you time your expenses. The choices you make ultimately will ripple through your financial future. And when you approach taxes strategically, on the other hand, they become more than just sort of a line item. on a balance sheet, they become really a tool for helping you achieve financial freedom. Now, that's what separates those who feel trapped by taxes from those who use them potentially as a springboard for creating wealth. It's not about avoiding responsibility. It's about understanding the rules of the game and playing it well. So, in this week's episode of Wealth Formula Podcast, I am going to talk about some of those incentives, especially as they relate to the new Trump administration. We're going to talk with someone who's been on the show multiple times and is a well-known guy by the name of Tom Wheelwright, the author of Tax-Free Wealth. Obviously, he's a tax strategist who's helped a lot of entrepreneurs transform their approach to taxes. He's the rich dad advisor to Robert Kiyosaki on taxes as well. So when we come back, Tom Wheelwright.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast, well, he's been on several times. He is what I've called the Michael Jordan of taxes. He is Tom Wheelwright. He is a best-selling author of Tax-Free Wealth, which is in its second edition. He's also known as Robert Kiyosaki's Rich Dad advisor. Always a pleasure. Tom, welcome to Wealth Formula Podcast again.
Thanks, Buck. Good to be here.
So let's talk first, I guess, about, it's been a while since you've been on. We've had an election since then. What are your thoughts on, the Trump administration and what kind of tone that's going to set for taxes?
Well, I mean, clearly the Republicans want to do the opposite that the Democrats want to do. The Democrats wanted to raise taxes, and the Republicans generally want to lower taxes. The challenge, of course, the devil's always in the details. And so especially where you have a Republican Congress that has such a thin majority, and the Democrats don't want to play ball at all. On the tax. So what you end up with is a very few people in Congress with an awful lot of power, very similar to what Joe Manchin and Kyrsten Sinema had with the Democrats in the last time. And so I think that's what's going to be the most interesting is you've got deficit hawks on one side, you've got you've got congressmen from New York and New Jersey and California that are Republicans, that they want the SALT cap lifted. So I think the negotiations are going to be pretty intense, actually, this year.
Trump tax laws that were from the previous time that Trump had an administration are set to expire, obviously, at the end of 2025. And that may not actually happen in practicality, but in theory, what would that mean for us?
Well, in theory, if it were to happen, which it's not going to, but if it were to happen, everybody's tax rates would go up across the board because everybody's tax rates went down, not just the rich people. Okay, everybody's tax rates would go up. Particularly entrepreneurs' tax rates would go up. They'd go up by immediately 20 to 30% for a business owner. The only thing that doesn't change is the corporate tax rate because that was made permanent. That was the one permanent change in the 2017 law. So everything else goes away. So that means we get alternative minimum tax back. We no longer have a SALT cap. We no longer have our standard deduction at $30,000. It drops way back down. We have personal exemptions again. Of course, the bonus depreciation is scheduled to phase out. We're at 40% this year. So that will just continue down its phase if that's not changed. So massive really massive tax increases because there were pretty massive tax decreases in the last one.
Yeah. So you kind of alluded to this, but you said it's not going to happen. What do you think happens instead in reality?
Well, I don't think it's going to pass the way it is because, first of all, you have some of Trump's promises during the election that are really expensive. And they include increasing the SALT cap. They include not taxing tips. They include not taxing overtime. They include not taxing Social Security. He's got a whole litany of them. And then you add J.D. Vance's $5,000 child tax credit. You're talking about, literally, if you took it all together, it's like $7 to $10 trillion of addition to the deficit. And that's not going to happen because you have the deficit hawks in Congress, the Republican deficit hawks that aren't going to let that happen. So then the question is, who are going to be the winners and losers? And that's really what we're looking at right now, because even if it's just the 2017 law, you have a potential of about 4.9 trillion. Okay. So you got to pay for that 4.9 trillion. Now, previously that was paid with, the SALT cap, that was paid with some, corporate tax changes. So the question is, we all talk about, and the only thing I ever hear anybody talk about is, well, what are the tax benefits or what are the tax increases? But nobody talks about what are the pay-fors. How is this going to be paid for, right? In the 2017 law, they allowed for a $1.5 trillion deficit, which appears to be more than that. Okay. Yeah. So probably 2.3, something like that, if you do nothing but keep it the same, right? Now, $1 trillion of that was the corporate tax rate reduction. So that brings it down already, right? So that's gone. That's not in this computation anymore. However, you still got to pay for it. Either you're going to pay for it in our children's futures, frankly, by increasing the deficit, increased interest costs, or you're going to pay for it by tax increases or something else. What are they going to do? Well, there are some things that we know they're going to do. They're going to really try to pull back on the inflation, that so-called Inflation Reduction Act from 2022, the green tax credits, right? All of those solar energy credits, the car credits, all that kind of stuff, electric car credits. They're going to try to pull some of that back. That's about $1 trillion. And they might actually prove that it's more than that. I think it's more, but it was scored. Okay. Scoring is an important word because how they score it is what matters, right? It doesn't matter what the reality is when it comes to passing legislation. What matters is how do they score it? How do they, what kind of money do they say is there based on their formulas that they use? And that's going to be, I think we're going to have losers. I think we could lose the qualified business income deduction, for example, which is the small business deduction. Yeah. I think that is at risk.
Which Tom, would you say, out of the things, out of the potential things that we may get back, we may retain, or which are the most likely? Obviously, like in this demographic of individuals that we're talking to, some of the things that are, real estate related, like bonus depreciation, things like that. Do you think that those are very likely to go back to 100%, or you think that that's not the case? Or there's some things that you think are more likely than others? What are those that we'll get?
I think we'll get the R&D deduction. Okay. Research and development. I think we'll get that back. I think we'll get bonus depreciation. I'm just not sure we'll get it for real estate. Okay. Because the big emphasis of this Trump administration is manufacturing. And the big emphasis last time was real estate, but the big emphasis this time is manufacturing. And so what you may see is that bonus depreciation goes to 100%, but only for equipment and only for manufacturing even. And they could do that. They could absolutely do that. The reality is, prior to 2017, what a lot of people don't remember is that we had bonus depreciation. It just didn't apply to real estate.
That's right.
So they could just bring it back to that level where you even got 100% write-off, but only for operating businesses or only for manufacturing. And, this idea of bonus depreciation on used real estate was a bit of a
Yeah, it was a change.
It was a bit of gimme. I mean, we're the only country in the world that's ever done it. And, I get why, because we were trying to stimulate housing, et cetera, and it worked. I think it largely worked, but we don't have the same lack of supply that we had in 2017. I understand supply is still low, but not like it was in 2017. So the question is, where's the emphasis going to be? So I don't know about bonus depreciation. If you'd asked me 6 months ago, I'd have said, yeah, it'll probably come back. I'm not so sure anymore.
Are there members in Congress that are opposing that particularly for real estate?
It's not a matter of opposing it. The question is, how are you going to pay for the other stuff?
Yeah.
So what's getting traction right now is the salt cap is going to go up to 20,000. That's pretty much a done deal. That's going to go up to 20,000. It's going to go from 10 to 20. The standard deduction is safe. So I get this is not the demographic of the people listening, but it's important because it's very expensive to have that high standard deduction of $30,000. What else is going to happen is the tax rates I don't think the tax rates are going to change. I think they're going to, even the top rate probably stays at 37%. Okay. Probably stays at 37%. Like I said, I'm not sure about the qualified business income deduction, whether that stays or goes. I'd give it about a 50-50 shot. I think that the not taxing tips in certain industries, I think that has legs. I think they're going to include that, and that's an expensive proposition. I don't think they can do the Social Security tax cap, not taxing Social Security, and the reason is because that probably requires 60 votes in the Senate, and they probably cannot do that in reconciliation, which is how they're going to pass this bill. So 51 votes in the Senate. So, those are the things. I think the IRS will lose some funding.
Yeah, I was going to ask you about that.
I think they'll lose some funding. I hope what they do is they take away. So if you remember, we probably talked about this on your show, Buck, in 2022, when they passed that new law where they gave the IRS $80 billion. First of all, they've already pulled back $20 billion. So now it's $60 billion. Of that money, $27 billion went into a slush fund for whatever the IRS wanted. $27 billion just in a slush fund. Another huge amount went to enforcement. Only about $8 billion went to technology, and specifically to technology and customer service. What there's a lot of push for right now is let's actually add to the technology and customer service, and let's pull money from enforcement and slush fund. And so I would expect it will be cut back. I would hope that it doesn't get totally taken away, because the IRS does need the money for customer service and technology.
Yeah, I was gonna point out too, that one of the big things that's happening is obviously this DOGE committee with Elon Musk and Vivek Ramaswamy, and if you've heard anything in particular from those guys regarding the IRS, because a lot of the things that they're talking about have been pretty paradigm shifting.
Yeah, for sure. Well, so one of the things that's, they've talked about is bringing people back to the office. And more than 50% of IRS employees are not in the office on a regular basis. So we'll see what effect that has. If those IRS employees will just quit, whether they'll come back to the office, because a lot of them moved, right? I mean, they didn't just say, well, I'm going to still live in Maryland or Virginia, but I'm just not going to have to commute. They moved to Iowa and Tennessee. So it's a real question whether they will lose, because of course that's one of their goals, right? We're going to bring everybody back to the office. We expect to have a lot of people quit.
Yeah.
And I think that'll happen. I do. And I think they'll also have a tougher time recruiting. That's probably a bigger effect on it, is that they're going to have a tough time. It's not easy to recruit for the IRS to begin with, but they're going to have a really tough time recruiting in this day and age, frankly, if they're not allowing remote work.
Yeah. Just so people understand too, like what there was a lot of money that was, as you just mentioned, that was allocated to the IRS. What was it supposed to do? Because I mean, obviously, it wasn't just supposed to sit in the slush funds and things like that.
No, most of it was supposed to go to either improving the base technology, which is way out of date.
Yeah.
But most of it went to enforcement, hiring IRS auditors.
Yeah. When in practical terms, we talk about a lot of these things that we anticipate, we're waiting to find out, these kinds of laws. From a timeline standpoint, when would we know like what's going to happen?
We're not going to know until fourth quarter of this year.
That makes it really hard, obviously, for tax planning because you don't really know, right?
That makes it really hard,
right?
Well, I mean, we'll stay on top of it. Certainly, I'll be talking about it on my podcast constantly.
Yeah.
As we hear things, right? I mean, for example, we already know some things that we didn't know a month ago, which is that the tips not being taxed. That's getting a lot of legs, right? It's getting a lot of momentum, and the SALT deduction. I mean, that's like pretty much at this point, I'd say it's done. I mean, that's going to be included. So it depends on, what goes on negotiating. Remember that the 2017 Act was done before Trump took office. In other words, most of those provisions were Paul Ryan and his predecessors, and they were not really Trump provisions. Trump endorsed them. Trump, pushed them through, all that kind of stuff. I don't want to take away from what Trump did to get it done, but they'd been a focus of 15 years of work. Okay. So now we're looking at, we're talking about some new ideas like the tips. Overtime, I can't imagine that passes. The not taxing overtime, I think that would be an enormous number.
Yeah.
I can't imagine it passing. But we're going to see. I think every week we're going to get a better idea of what's got traction, what hasn't. I'm looking forward to hearing somebody start talking about bonus depreciation because that's probably, certainly for your listeners, that's the biggest piece of this legislation.
Yeah. Another topic that is kind of big this year, and you're probably seeing it in a number of your clients, is cryptocurrency. Currently, we're experiencing a little dip here, but people have been thinking that generally this is going to be a big year, and a lot of people are thinking, well, maybe this might be the time for me to exit. Maybe you could explain a little bit first, how is cryptocurrency taxed? And is there any current legislation about potentially changing that?
So cryptocurrency is not taxed as currency, which is really interesting.
Right.
It's just taxed as property. So it's no different than if you sold your car for a gain, right? I mean, it's property. And so it's capital gain if it's over a year, and it's short-term capital gain, long-term after over a year, short-term capital gain under a year. One of the big issues on cryptocurrency is, are you going to be able to select which tranche you sold? Okay. So cryptocurrency is fungible, right? Just like stock in Apple, stock is stock in Apple, right?
Right.
Bitcoin is Bitcoin, right? In the stock market, you can pretty much say, well, look, I'm going to go first in, first out, or I'm going to specifically identify, I'm going to sell this stock that I bought on this date, and that's what I'm selling. You can do that right now in cryptocurrency, but the IRS has proposed regulations that you would not be able to do that.
Yeah.
So that's going to be really interesting to see what happens this year on reporting. They've deferred it for a year. I think we're going to get a new IRS commissioner to replace Werfel. Trump has proposed a new IRS commissioner who does not have a lot of experience. He was in Congress on the Ways and Means Committee, but other than that, has really very little experience in tax administration. So we'll see. I will tell you, one person that everybody agrees is a terrific appointment from a tax standpoint for Trump is Kenneth Keyes. Ken Keyes has actually been on my Wealthability show. And Ken is actually a veteran going all the way back to the Reagan administration. And he will be very involved in the tax policy discussion. He's got an enormous amount of experience, just an enormous amount of experience. And he's a very level-headed guy, And I would suggest, go read, what he's been talking about, read his stuff, listen to what he's been putting out there, because I think he's going to have a lot of influence on the details of what happens, both in the IRS and regulations, as well as what happens in tax policy when they, come up with the laws. Because that, obviously Congress and the House and the Senate, none of that wants to come up with laws, right? The people who come up with the laws are the people who work for them, right? The accountants and attorneys are the ones saying, here's how this ought to work. And they're the ones who actually write the law as well. The people in Congress don't write the law. Their staff writes the law. And so, when you've got to pay attention to some of these staffers. And of course, Ken Key's not a staffer. I mean, he's, a deputy secretary of the Treasury. So that's an important position. I think we're going to see some well thought out policy, I hope, and including on cryptocurrency. I think the cryptocurrency is, they need to make a decision one way or the other.
Yeah.
Is this going to be currency? Is it going to be taxed as a security? Because it's not a security either. It's not a currency. It's not a security. What is it? I think they need to finally make that decision this year, and I think they very well may.
And along that line, so just coming back to what it currently is, it's essentially personal property, right?
That's what it is.
And so the question is, so if you own cryptocurrency as personal property through an entity and you sold it and you got a profit, is that essentially passive gains?
No, it's portfolio.
Is it portfolio
income?
Okay.
Yeah, it's not a business because
Right.
remember, being in business is an exception to the rule, right? The general rule is nothing's business until you make it business. You have to prove that you're in business.
Right.
And cryptocurrency is not going to be,
But it is classified then as portfolio income. I didn't know. I thought that it was personal.
Capital gains are portfolio income.
Right. Okay.
By definition. If it's not business income, so for example, you sell real estate at a gain, depreciable real estate, it's a 1231 gain. Well, that's a business gain, taxed at capital gains rates, but it's a business gain, okay, as defined in the law. But if you sell stock, or you sell your car, your personal car, or you sell your personal home, or you sell your wedding ring, or anything you sell that's personal,
Right.
That's not real estate.
But if it's owned by an entity, though,
doesn't matter.
It doesn't matter?
It doesn't matter. The only difference is it would matter if it's in a C corporation, because in a C corporation, of course, there are no capital gains rates in C corporations. So in a C corporation, it'd be taxed at 21% plus whatever the state rate is. There are no special capital gains rate in the C.
Yeah. Yeah, I'm asking in part because I actually introduced people to Bitcoin on the show in 2017. Some people are sitting on some huge profits and have actually asked me, is there anything that we can do here? And I'm sure you've had those same conversations. Is there any thoughts on this, or is it just what it is?
I mean, there are. So first of all, remember that any kind of capital gain can be rolled into an opportunity zone property.
Yeah.
Right. Mm-hmm. So you can use capital gain from Bitcoin for an opportunity zone investment. So that's one thing you can do. Second of all, remember that it's capital gain. So it can be offset by losses. So if you have losses let's say you have losses from some other cryptocurrency. One of the things we still don't have is a wash sell rule with regard to cryptocurrency. So you could sell it. Let's say you've got cryptocurrency that has lost money. I mean, for example, there are people who bought Ethereum, and it's less than its high, a few years ago. Right. And so you could sell that, take a loss on it, buy it back, keep it in your portfolio, but take that loss and offset your gain from your Bitcoin, for example. Mm-hmm. Or you could donate your Bitcoin. I mean, here's one, I think one of the best things that people can do who are charitably minded, because I know a lot of your listeners are charitable. Donate your Bitcoin. Don't donate cash, because you won't recognize the capital gain and you'll get a deduction for the fair market value. It's just the same as donating Apple stock. So donate Bitcoin instead. I mean, why anybody would donate cash that has highly appreciated cryptocurrency, I don't understand, because you eliminate the capital gain and still get the same deduction if you donate the cryptocurrency.
What are your thoughts on some of these? There are some of these more exotic things, like, I don't know if they're exotic, but like charitable remainder trusts and things like that.
Charitable remainder trusts have been around as long as I've been around.
Yeah.
So they're not new. They're not exotic. They have been misused recently.
Could you just describe them for people real quick?
Yeah. So there are two types of charitable remainder trusts. Charitable trust. There's one where you put it into the trust and you get all the income during your lifetime. And then when you die, the charity gets what's left. Okay. They get basically what's called the corpus of the trust. They get the asset. That's a charitable remainder trust. You get a deduction currently for the net present value. So you got to discount it back, right? Based on interest rates. So interest rates are high right now. So net present value is low, but you get a discounted charitable deduction for the current value of what they're going to get in the future. Okay. Basically the current net present value of what they're going to get in the future, discounted value. That's a remainder trust. Now there's also basically a unit trust or an income trust, where the charity gets the income and then your heirs or your estate, they get the remainder. So you can do it either way. And there's a lot of different combinations of them. I think if you're going to donate assets when you die to a charity, I think by far the best way to do it is through a charitable trust.
Right. And charitable LLCs are another thing that comes up. Are those, how's that different?
Yeah. So typically what people are doing there is they're donating to a donor advised fund. They're not using a trust. So what they're doing is they're putting their highly appreciated assets into an LLC. They are donating an interest in that LLC to the donor advised fund, which then you get to tell the donor advised fund where, what charities do you want it to go to, et cetera. And if you don't sell it, you have control over it, right? You're the manager of the LLC. So you have control over that LLC that owns the Bitcoin, say, for example. And as long as it's not sold, it's just going to sit there in the LLC. I mean, the charity is not going to demand, hey, you have to sell some of this so we get money, right? Because it's a liquid asset, if you will. They would like you to sell it because they want the cash, right? So they may put some pressure on you to sell some of it from time to time because they do want some cash. But it's not a bad way to do it, frankly, because you get a much bigger deduction than a charitable remainder trust because they're actually getting the value now. And I think it's totally legit. I don't think there's any.
So these strategies are essentially just taking profits in the form of tax deductions. Is that right?
You're not taking profits. Okay.
Well, you know what I mean? Like your theoretical.
You're giving up the asset. So
you're giving up the asset, but I'm saying what your personal benefit in there is actually just a tax deduction. There's not.
Correct.
Because, I've heard all sorts of crazy things about, taking loans against it and all that.
That's where you get into trouble.
Yeah.
Right. If you actually have beneficial use of the asset, you have not donated it.
Yeah. Right. Right.
Right. As we always like to say, pigs are cute and hogs get slaughtered when it comes to tax deductions.
Yeah. Got it. Right now, if you look at, the potential tax opportunities that a lot of times people in the higher net worth group, like high paid professionals, who ordinarily would just look at real estate and, they've got try to play their passive income game that way. But if they're looking for other opportunities, what do you think some of the ones that are the best that people are missing right now?
Well, the hot one right now is oil and gas, right?
Mm-hmm.
That's the hot one. First of all, you don't have the passive loss issue, right?
Yeah.
As long as you are a general partner, you have no passive losses. You don't have a passive loss issue. You can take it against your ordinary income. So that's probably the biggest one right now is oil and gas, especially since oil and gas prices are pretty high. They're up close to 80 a barrel right now. And there's a lot of emphasis in this administration that's pro oil and gas. So that would be probably the biggest single one from an investing standpoint. There are some others that are interesting, which include agriculture, and particularly when it comes to getting some type of a carbon, the carbon credits.
Yeah.
And that's actually it's a very sophisticated. I am not the expert in that area.
Yeah, sure.
But there's it's pretty interesting what people are doing there. I mean, even if you just look at it from and I put a chapter of this in my book, The Win and Wealth Strategy, about, let's say you go and you buy timberland, right? And you plant the timber and so forth. Well, there are carbon credits associated with that timberland because, right, it produces oxygen. And so there's a tax play on top of the regular business aspect of it. And that's really what you're always looking for from an investing standpoint, right? What's the tax benefit of the investing, not just the tax consequence. In other words, not just how is my income going to be taxed from the investment, but what kind of benefit do I get up front?
Yeah.
And, timber, farming, agriculture has always gotten tremendous tax benefits. And so I think it's not just energy right now, but I do think we're going to see more and more in the agriculture, particularly the timber industry.
Interesting. Well, Tom, tell us, obviously, you've got this great company called Wealthability. Can you tell us all about that and what that's all about?
Yeah. So we since we last talked, Buck, we made a few changes. First of all, Wealthability no longer has a network of CPAs. What we did was we actually decided we want to have more control over the quality of work that our CPAs do. And so we created a franchise. So we have an actual franchise where we are co-owners of their business, and like any franchise, like a McDonald's franchise, only we're doing tax advice and tax work in our franchise. So we have a number of franchisees around the country. They are top-notch CPAs. And so that's one thing we're doing. The other thing we're doing is I'm actually doing a lot more of my own education where I'm taking groups of people and taking them through tax strategies. And that is through the Wealthability brand. Yeah. That's going to be in the form of a mentorship, in the form of taking people actually right through. We call it the Wealthability Accelerator Program. We have we have more applications than we can handle, but we'll of course take new applications in hopes that you want to get in now, because we're only taking 40 people in this accelerator class, and we already have more than 40 applications. So that means that it's good news is we just launched this a few weeks ago. So we've had very high demand for it. And hopefully if we fill up one class, maybe we'll do another. That depends on how much time I want to spend at it. But it's an opportunity for me to actually work directly with entrepreneurs, because it's too much time for me to work one-on-one with entrepreneurs.
Sure.
But this way I can actually work with a group of entrepreneurs.
Yeah. And so if somebody wants to look into one of these things that you're talking about, what's the best way to get a hold of you?
Actually go to the Wealthability website. So the website is in full force there. Look for Wealthability Accelerator, or go to the TFW Advisors website, which is the franchise.
Great. Tom Wheelwright, everyone. Tom, thank you so much for being on the show as always, and looking forward to the next time.
Thanks for having me, Buck.
You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for, and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. Yeah, Tom's always great to talk to. The one thing I will respectfully disagree with him, though, on is I don't think, and I could be wrong on this, but I really don't think that real estate is going to be left behind on the bonus depreciation side. It's just, I mean, it would be so out of character for the Trump administration to do something like that did not benefit real estate. And while it benefited, other types of depreciation. So, I mean, that's not a tax thing I'm disagreeing on with Tom, but I will say it is a policy thing that I think that, I just don't see how that is going to be left out of this big, tax deal. However, is very, I will just say we respectfully disagree on this. So Tom is a really, really smart guy. I certainly wouldn't argue with him on taxes itself, but that issue, I would say, I am willing to bet. Other things just to mention, we mentioned the Accredited Investor Club. Join it if you'd like. There is some activity in there right now that you may not want to miss. The other thing is, I don't know if you guys are out there in the crypto space, but for those of you who listen to me talk about Solana, it's up about, I don't know, it's up about 100% from when I suggested we get on that. That is something, if you are looking into cryptocurrency right now, think about the fact that there is this meme craze, right? And you saw that with Trump coin and Melania coin and stuff like that. The key is all those things, all these meme coins are really being built on Solana. So, again, I'm not going to give you investment advice, but I would suggest that if you're in that space and you don't have exposure to Solana, think about it. Anyway, that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.